Hello and welcome to this week's episode of Nucleus Investment Insights. The topic for discussion today is the 6 Horsemen of global recession. On the agenda, we'll look at the 6 potential shocks for a global recession scenario. First, we'll explore global tightening, looking at the fiscal and monetary policy. Then we'll look at the European economy, specifically in regards to the war and energy. Next, we'll investigate the Chinese economy in relation to their property bust and COVID. Then we'll discuss the US economy and the Fed. The 5th horseman is the Spanish flu analogy. And then lastly, we'll talk about markets and their implications. My name's Sam Kerr, and I'm the Senior Financial Advisor at Nucleus Wealth. As always, we have Damien Klassen, the Chief Investment Officer at Nucleus Wealth. Damo, great to have you as always.
Hi, Sam. How you going?
Good, thanks. We also have our Chief Strategist at Nucleus Wealth, David Llewelly-Smith. Dave, hi. Thanks for joining us. How are you going?
Great to be here. Thank you, Sam.
Excellent. Thanks, gentlemen. Just a quick reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, follow us on your preferred podcast platform. Our show is available on all the majors. And for those of you listening live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now we've got that little bit of housekeeping out of the way, we'll get into it. So Damo, I'll hand it over to you to get us started.
Yeah, sure. So look, Dave's going to drive most of this, but I think the key thing we wanted to, I guess, what we're looking at is your markets have obviously had a pretty good bounce off their lows, and the question from here is, is this that the war's been incorporated and it shocked everyone at the start, but now people are comfortable with what the risks are, and it's time to go back to where we were. Or are there other sort of darker clouds sort of hovering, and this is the bounce you've had is a bit of a chance, if you haven't already sort of lightened up on equities, to have another crack at lightening up. So with that, we've sort of looked at six major things, and we'll start with the financial and monetary conditions. So we've obviously had central banks starting to raise rates, in particular the US. Raising rates, and also governments sort of globally pulling back, and that sort of leads to this horseman number one. And I'll pass across to you, Dave, to jump in.
Sure. So this tightening actually started last year in emerging markets, who began raising interest rates and cutting fiscal spending in some cases as well. And after the inflation that began in emerging markets last year flowed through to the developed markets this year, we've got our own central banks scurrying to hike rates, of course, most particularly in the US, leading in the US because inflation is strongest there. And some of the other jurisdictions have more time, but they may get some rate hikes away as well. And then this is combining with, a lot of reduced fiscal spending, which some of which is deliberate and some of it is just base effect as stimulus rolls off. But it's a lot. It's roughly $3 trillion of fiscal retrenchment over the next 12 months globally. And so, the two tailwinds that saved us from COVID, if you like, through massive stimulus, both interest rates and government spending, are being wound back at a furious pace. And so the question is, can the global economy handle it? The first couple of charts I've put up here suggest that it will create problems as we withdraw from this kind of stimulus largesse. The first one is a global financial conditions index from Goldman, and it incorporates all sorts of different things from interest rates themselves to various spreads to equity prices to all sorts of things. But if you have a look at the left-hand chart, you'll see that the global version is about as tight as it's ever been. And so you will expect global growth to automatically slow down quite severely on the back of that. and we are starting to see that as we'll go through in the various economies. Now, on our right-hand chart there, we've got one that is both kind of upside and downside, I guess, depending on your perspective, and that is that the US financial conditions index is still incredibly loose, which is perhaps one of the reasons why the post-war kind of rebound in equities has been so strong, because liquidity is still there, but it has turned sharply and is tightening quickly as well. But the interesting thing about this, I guess, is global liquidity is so tight before the Fed has even tightened US conditions. And so, as the Fed's going to keep going, then those global conditions could get very difficult indeed, especially for kind of US dollar shortage, etc. So Horseman number one is simply, the kind of post-COVID wind back of what was something like $32 trillion worth of stimulus to get us through, and so that alone is going to cause quite a bit of volatility in asset prices, I suggest. However, we actually have a range of other shocks going on, which are, I think, potentially going to make it more difficult again. So we'll go through some of those major economies as well and look at their specifics, because some of these shocks are quite idiosyncratic. And so starting with Europe, everyone will be aware that we've had the Russian invasion of Ukraine that's resulted in very strong sanctions, especially on some commodity prices, not energy in particular. But the end result has still been reduced energy flows out of Russia, both gas and oil. We think that a lot of the oil will come back in time, and some of the gas as well, probably via China and India. But for the time being, that's driven some of the energy prices really high, in particular gas into Europe, which is, a feedstock for a lot of industry and warms an awful lot of households. To give you some notion, generally the Dutch TTF gas price is hovering around $10, $12, $20 tops. It's been as high as 230 recently. It's back down to about 120 at the moment. So it's a huge energy shock for Europe that's already shutting down, some gas-dependent industries. And the war itself as well has really hammered both the supply and demand side of households, and business confidence has been absolutely trashed by it. And you can see that in two of the charts I've got up here. Just consumer confidence in the EU is now as low as it was during COVID. And the German IFO, which is a pretty good leading indicator of the German economy, at least in terms of its manufacturing sectors, has also dropped very sharply. Not quite as bad as COVID, but as low as it was, in fact lower than it was during the European debt crisis, and certainly low enough to be concerning. So we're already seeing those impacts from the war. And I've added, actually I'll come back to that one. Now we do have some offsets to this in Europe in due course, which is that it's trying to urgently rejig its energy supply chains away from Russia. So it's looking at spending a lot of money to do that, through various means and mechanisms, for everything from boosting renewable energy to transferring its purchases of energy to those within its sphere of influence, or to allies like the US. However, this is going to take time, and we know that Brussels never moves quickly on anything. And so, there's going to be a lag on this.
And the other problem is obviously that they just can't produce the amount of solar panels and wind turbines and things like that you need to transfer a significant amount.
Exactly. Yes. So
you need years of that building up.
You will. Yes, years of that building up before, and that's after we finally get some funding, which we'll have to go through the various laborious mechanisms of the Eurozone.
Yeah,
so
as everyone, well, as all the manufacturers basically put their hands out for whether it's going to be French manufacturers or German manufacturers or whatever it is, who all want to be first in line for
absolutely
for
for some subsidies, for sure. So fiscal is going to lag. We think in Europe it'll take time before that boost comes through. And in the meantime, its inflation yesterday was really red hot. It's starting to really chase the US higher. And so I don't think the ECB is about to sort of take off. It's got much higher unemployment than the US does. And so even though it has kind of stronger underpinnings, shall I say, institutional underpinnings to wages growth than the US does, unemployment is still okay in the EZ. So I mean, the ECB doesn't have to rush, but it is starting to think about tightening. So there's shocks hitting Europe, supply and demand, and the ECB is thinking about tightening, and the fiscal is going to take time. And so I think Europe basically is in danger of a recession intrinsically. Or endogenously, before we even talk about the rest of the world. And this is where I get to the final chart on here, which was just shows the most recent European PMIs, which were quite strong at the headline level. But for those who know how to look under the bonnet, we're actually very weak because and especially in the leading indicators like new orders and new export orders. If you look at the chart there, you can see they've suddenly crashed to zero growth, and so it's endogenously weak and in danger of recession, and it's about to like take a external hit as well, which is a good jumping off point to China, because the forces are different there, but the overall scenario is actually very similar, and they're not dissimilar economies either. They're both kind of mercantilist, export-driven economies. So in China's case,
and I guess just to put that in perspective, what David means by that is, typically US and UK, Australia, Canada are all basically net importers of a lot of goods, and are out there. They're sort of providing the demand, whereas a lot of Europe and China is providing the supply.
Yes,
and so
exactly.
and arguably, that's because wages are too low in both, say Germany and China,
Yep.
for relative to other countries.
Yes.
But yeah,
and currencies as well.
Mm.
So yes, I mean the overall shape of the problem confronting Europe is very similar in China, and that is it's got very weak domestic demand. In its case, however, it is the property bust that is unprecedented. It's the largest property bust I've ever seen in China, and we probably have to go back at least 20 years, probably 25 to the pre-millennial stuff to get anywhere near it. I've got a chart here from Goldman showing recent. This is construction of homes, by the way, new housing, and largely apartments for that matter. Is down by half year on year. The official numbers haven't caught down to this low yet. They've been hovering between 20 and 30% down. So there's some, kind of debate over just how deep it is, but it's certainly deep enough either way. And as we know, property, constitutes somewhere between a quarter and a third of the Chinese economy. And so this is a huge headwind for growth in China. Now, a lot of people have been sort of expecting a bailout for the sector, but it just isn't coming, and I don't think it's going to come. There certainly is looser policy, and I expect more because they have no choice, given this is going to really land on growth very hard. There's a lot of local area easing now on macroprudential measures, and I expect the PBOC to ease a lot more as well. But I do not think that the driver of it is going to change unless there's a real kind of wipeout in the economy, and that's the three red lines policy that's there to rationalize these amazingly over-leveraged developers. And so while that is in place, basically both the fiscal and monetary efforts to lift growth are kind of pushing on a string, because you have this intense macroprudential headwind for all property developers, and it creates real doubts in the entire property market. So you end up with this kind of counterparty risk for buyers of property who are concerned they'll never get their property delivered. There's huge counterparty risk for the funding of the developers, and they can't get money because it's all so expensive because they're so risky. And so that is just an ongoing adjustment that is, managed and it's deliberate, but at the same time, it is probably deeper and more unruly than they wanted or hoped, and it's certainly developed into a very serious economic headwind. So that's
and it's
sorry,
worth saying as well, yeah, that like it's a very slow motion event that's going on in terms of, say, Evergrande is probably the one of the poster child for the problems. There's plenty of other developers in the same position as Evergrande or worse, but that's been going on for 2 years now, possibly even 3 years, and it's sort of this. It's not quite a default, but it's close, and at every stage it's sort of like a one step further down, and then a lot of announcements about how things are going to be changed, loosening, or small things that are being done to help developers, and then 2 months later you get another step down, and then the same thing, same factor again, and each time I feel as if there's obviously China's trying to manage the optics of it and making sure they don't, or trying their best not to cause a massive property crash within it. But I think the positives can be read far too optimistically, or have been read far too optimistically every time. Is that, oh, okay, we've just reached the bottom, and then now everything's up from here, and then no, it's not, and then the next 2 months later, same story, all the way.
Look, I've forgotten how many times I've read it's the bottom in Chinese property over the last 18 months. So exactly right. Could it be the bottom now? Yeah, maybe, but it doesn't look like they've solved the fundamental problems. Well, I wouldn't put it that way. The adjustment just needs to run further if they want to take it seriously, and the difficulty of counterparty risk that's kind of holding it all back just can't be resolved by cheaper money or anything else of that nature. So I don't think it's about to rebound terribly strongly at all. So that brings us to our second shock that's now, really starting to hit Chinese growth, and that is Omicron, which has, kind of skipped the, it skipped the boundaries, as it were, that containment, and began in Hong Kong, spread to Shenzhen, and is now in Shanghai, and they've all been forced to shut down as it's whipped its way around the country. At the moment, the cases are still getting worse in Shanghai, and it's just about in every province in China now. Roughly a third of the provinces are all on like the high risk, medium or high risk category. So they've got some form of mobility constraint or actual lockdowns underway. Now, I it's in the lap of the gods whether the CCP, with all of its controls, can tackle Omicron successfully. What is clear, I think, is that the effort to do so will need to be ongoing and be a non-stop headwind to growth. Even if they succeed, they can only succeed by hitting growth, is the point. So I've got a second chart there on the left, which shows, the degree of kind of lockdowns in China are now the highest they have been since March 2020, and basically still climbing. They may not get higher than this, but they don't need to, is the point. They'll just be chasing Omicron around China for the next, forever, as far as I can tell, until they reach a point where they have no choice but to sort of let it run. But they're not there, and probably for good reason. They really have, their vaccines are lousy, and I've read some, pretty scary kind of estimates of the death rate that they might get if it does manage to get away. Their elderly particularly are unvaccinated, and so it's like, some of some have analysed it at like 40,000 deaths a day if it gets out. So this is why the CCP is determined to remain zero COVID, but it is going to start hitting growth. Well, it is hitting growth already, and it's making the property bust worse as well. So
and Xi has made a fair point personally about the whole, China's there to save Chinese citizens. It's it's got zero COVID, unlike the sort of decadent West, and
Yep.
and it made a point about how badly a lot of other countries were doing, over the last couple of years, whereas China's doing quite well, and so it's very hard to flip that narrative
yes,
quickly.
it is. So I don't think they will. I think they'll keep going. Where that ends is an interesting question, but not one we need to tackle today. So, so there are offsets to this. They're trying to spend fiscally, sensibly enough. There is monetary easing coming as well, but the main effort is fiscal so far. However, there are, limits to that. Like lockdowns don't let you stimulate fiscally, particularly either. Like they would if they were demand based, like the US does, but China doesn't do it that way. They try to spend on the supply side, and that's not going to work if you're locked down. In addition to that, the property bust is having a very, very deleterious impact on the budgets of local governments because of the land sales that they generally get out of it, which is about a third or a 40% of their revenue, and that's getting absolutely hammered. And so, despite more money coming from federal authorities, the local governments are constrained. So, and there's lots of confused messaging coming out of Beijing about deleveraging versus supporting the economy. So, there are the transmission of fiscal policy right now is also kind of pushing on a string a little. Not as much as monetary, I don't think, but both of them are constrained. So the one bright spot that's really, because all of this has kind of been in place now, certainly for most of last year, which is why China's growth slowed so much. And the one thing that was kind of sustaining the economy and supporting growth was exports. They had an absolutely extraordinary export boom in volume terms. And some of the investment that comes after that into new capacity is what's held the economy up over the last couple of quarters.
And actually, just to confirm as well, that export's largely driven by the US in particular, spending a lot more on goods
Europe
and services.
Yes, the US and Europe. So, and as I indicated in that previous set of charts on Europe, we can see, export demand starting to wane globally, and there are other indicators for that. Other North Asian nations, in particular, Korean exports, which are quite dynamically tracked and announced, are also fading really fast. Same in Japan. The Japanese PMIs are showing exports fading really fast. So basically, the global economy is slowing, and so China as well. This is where we come back to the same shape as Europe. So weak domestically and about to be hit with declining exports. So external shock going to pile in on endogenous weakness, and so then we've got that in both China and Europe simultaneously. So the potential to get feedback loops into slowing growth is there. So that's covered 5 of our horsemen, and we'll just flip over to the next page and come to our 6th, and this is the granddaddy of all horsemen and the driver of kind of the global cycle, and that is the US economy has been absolutely booming, of course, but like I suppose what you would call overstimulus. I don't really blame anyone for it because we're fighting COVID. Has resulted, in something of an outburst of inflation in the US, starting on the supply side, where we had constraints and stuff. But then now the US labour market is very tight, and so we're starting to see some pretty good wage gains. And so, the US is looking at a possible wage push inflation cycle, which is, what really scares central banks. And the end result of that is that we have a Federal Reserve that has pivoted the most hawkish I think I've ever seen in rhetorical terms. Certainly more hawkish in its oratory than I ever saw from Alan Greenspan. I mean, there are some really strong words coming out of the Fed at the moment. And so market pricing for forthcoming hikes this year is very aggressive. Everybody's starting to price 50 basis points hikes, multiple versions of it, not just 25. 9 rate hikes ahead for this year, and possibly some more next year, although that has started to roll over. But the bottom line is you've got a very hawkish Fed draining liquidity, which is an overlay to what the last 2 major economies we just talked about that makes it more difficult for them. But the Fed's determined, it set itself to crush demand to fit supply so that it kills inflation. That is not a very wise thing to do for a central bank if it's based on supply constraints, but they're going to do it anyway. And so, we're already starting to see some stress coming out of this, certainly in the wider global economy that's dependent on the US dollar because it's been rising in emerging market spreads and stuff like that. But we're also like US mortgage rates have gone through the roof. They're, of course, a lot of people will know they're fixed rates. They're not floating, so doesn't hit more current mortgagees. But what it does do is land very hard on new demand for mortgages. And right now I've got a chart here on the right showing that housing affordability with these recent something like what
2%ish.
Yeah, well, but the rate rise effectively in the mortgage market in the US is nearly 2% over the last 6 months. Yes, and it's just absolutely hammered housing affordability. So,
and to put that in context, you've gone from being able to get a 30-year mortgage at whatever 2.5% and to 4.5%.
Yeah,
so
in like 3 to 6 months.
Yeah.
So because these fixed mortgage rates are attached to the 30-year bond, they've actually priced nearly all of the tightening in advance because the bond yields are reflecting what they think is coming. And so, US housing market is something that's very, very much worth watching because it's going to slow pretty snappily, I think. And of course, with that, you get all kinds of household goods kind of demand diminishing. And then there is, of course, the regular normalization that we've been expecting all along and is happening, and that is where we're shifting from the elevated goods demand based on stimulus during COVID when people couldn't go out to more normal patterns of consumption where they can go out and travel and eat and get a massage, etc., and so spend more money on services. And so you've got a potential demand crunch coming out of the US. You don't even need to call it a crunch. It could just be a normalization where we get back to previous patterns, and it will flow out into the global economy, and goods demand for Chinese and European goods will get hurt quite quickly and quite a bit because that's what, in particular, what China has been trading on for the last 2 years is that irregular pattern of consumption in US households. So you got all of these things kind of converging. There's one thing I didn't put in here that I might as well add, which was that the US has basically entirely rebuilt all of its inventory stocks in goods as well, in most segments, not all, but most. And so if there is a demand hiccup here, then I expect inventories to actually stay higher than historically because we've got it's one way of managing kind of supply chain stress and risk, but there is definitely a possibility that they've overbought, and there's been double buying and double stocking and things that could potentially unwind if we get this demand hiccup as rates go up. And so on top of that, of course, and I'll come back to this possibility. We've already seen more volatility in more financial assets that can also hit demand, or a possible credit event which is usually what happens when the Fed tightens, especially this quickly, this steeply. Something goes wrong, someone bets wrong, and something snaps in financial markets, and so there's that risk as well. But that may not even be necessary for the global economy to really get damaged here. So all of that kind of detail of the three major economies in the world, all kind of confronting these intensifying headwinds, and in most cases actual shocks, actually has a really neat historical analogy with the Spanish flu, which we've all been watching, of course, during COVID, as the model for how to handle things, with flattening the curve and various other kind of experiences for public policy during pandemics. And so, it's really interesting to observe that following World War I and the outbreak of the Spanish flu, we likewise to now, we had lots of stimulus and lots of supply chain disruption. Like it was a period coming out of the kind of late 19th century when the world got heavily globalized, especially under the kind of the imperial structures of the day, and then the British Empire in particular.
This was pre-World War One, so
yes,
yeah.
that's
So
right.
the idea was that it was, and a lot of these arguments that there could never be a war because of how much globalization had happened and how intertwined everyone's supply chains were. Was part of
Yes.
the reason why the World War One couldn't happen, so to speak.
Yes, and it did, of course. And so this, there was a circumstance very similar where supply chains got heavily disrupted by both war and a pandemic. Inflation surged, and then the Fed hiked really dramatically into it to kill the inflation, and within a year it had a depression, basically. So there's a second chart here which just shows the severity of the hikes during the kind of 18-19 period, and by 2021 there was staggering deflation in the US economy of up to sort of 16-20%. Like it was a real hammering. Now some of those conditions are different. Obviously the end of the war released some more labor back into the US economy, and so some of the deflation came from different kind of sources, but it was a hell of a bust, and it was largely monetarily driven. So it's a pretty decent analogy for where we are today, quite frankly. So that's a way of, I guess, of parsing all of these various details into a historical analogy that makes a fair amount of sense. So flipping over to implications for markets, what does it mean for assets? Well, we're already seeing the sort of key recession indicator that everybody watches, at least markets watch, bond markets especially, in an inverted yield curve, which has been coming for months now. What that means is basically short-term rates are now higher than long-term rates, and so it's telling you that there are basically rates cuts coming, down the track somewhere, which is obviously a reflection that your growth is going to fall. And it's quite a reliable indicator of recession. There are various ways of reading it and various measures of it. The key one is 2-year versus 10-year bond, and that inverted this week in the US, and it looks like I think it'll probably invert a lot more. So that's the first thing that's got people talking. There's lots of people saying, well, it's not really a signal anymore because central banks, have been messing around with bond values so much, and I just don't buy that at all. I think markets adapt to whatever the prevailing conditions are, and so it looks quite informational still to me. And I always hear these excuses at this time of the cycle as well. There's always an excuse to keep bidding for equities. So I'd ignore that. I think it's a legit signal. So, where stocks kind of were repricing successfully through, the last 6 weeks or so, I guess, after Russia invaded Ukraine, the adjustment really got moving. But of course, that's all reversed now, which is pretty typical for when wars break out. Markets kind of sell off and then rebuy. But that rebound, as some are arguing, is now a new reflation, and there's just I just don't buy that at all, given everything in this presentation, and in particular the Fed tightening directly into it. And inflation is very, very high still. Don't forget. I mean, we still maintain that a lot of it is going to deflate. That a lot of the supply side stuff, they were all easing a lot before the Ukraine war, and they will continue to ease, especially if the economy slows. They could ease really fast, and in fact, we'll see slack. But while inflation is high, the Fed put, which is the level at which the Fed is forced to stop raising interest rates because the stock market is crashing, is lower than it has been because inflation is higher, which means stocks will have to fall further to knock the Fed off course. And to be honest, I think the Fed needs a commodities bust to, added to that to really, if it wants to really kind of put inflation to bed. We've had what was an extraordinary kind of narrative, I think, which was on the verge of breaking down and going bust for a commodity super cycle when Russia was invaded, and that has given it new life, and legitimately, in some senses, it really has kicked the can down the road for that. But that just means that the Fed is now confronted with a more volatile cycle where the inflation's a little more embedded. It's got to go a bit higher and a bit faster to kill it off, and so we get more boom bust kind of shape of cycle. I expect, therefore, for the US dollar bull market to continue. I think it's got another leg higher, just as safe haven. It's selling off at the moment, sort of on the post-war unwind, which is fine. But I think as the world kind of shunts into this lower growth thing, and don't forget that a global recession is anything around 2% is generally thought of. It doesn't have to contract. So that's kind of what I'm talking about. I don't know exactly how weak it would be, but that's weak enough for it to hit earnings, like lower earnings. And we have this very highly valued stock market, and those two things don't go together. So I'd also expect the Australian dollar to fall, have one more leg lower at some point as this thing plays out, as kind of, I guess, risk off and stocks kind of finally reprice a post-COVID rescue bust. And there you have it.
Right. We've got a fair few questions there, Sam.
Yeah, we've got a couple of questions coming through. Quite a few questions about deglobalization, and then also about inflation and interest rates. So we've got one question here asking about whether central banks are the cause of this inflation, for keeping interest rates too low since the GFC, and not really taking into account this deglobalization that's looking like it's happening.
In a sense, they are, yes. I think excessive liquidity, creates deflation eventually, not inflation. Because it just protects the supply side too much. You get a lot of, you never get a clean out on any cycle in terms of, kind of that Austrian style economics, which is, very good, I think, at reading the dynamics of a business cycle. And so you end up with too much supply, and you end up with too much deflation, and so kind of interest rates stay low forever. And then, yes.
And having said that, though, they're working within the tools provided to them by governments who are generally who are generally happy for more inequality for inequality to grow, and that's part of what David's talking about in terms of saying that it's this cycle where if interest rates are low, then if you're a business, you get to invest quite cheaply, which then gives you the excess capacity, and then keeps that deflation low. But the problem is we've got these consumers out there who can only consume if they can borrow more debt, and then Australia is a great poster child for that. And so you need to keep lowering interest rates, because every time you put interest rates up, all of a sudden consumers can't buy the stuff anymore because they're too busy paying their huge debts down, or not even paying them down, paying the interest on their huge debts. And so therefore, they need to lower rates in order to keep the whole thing from imploding. And so you can blame central banks certainly for keeping interest rates too low, but you also got to acknowledge that they were trying to keep demand. What they were really trying to do was keep demand ticking over, and there was no fiscal support for any of that demand, and there was no commitment to sort of trying to help inequality. And in fact, you'd argue that the opposite was happening.
Yep.
And so that's where they were sort of trapped. And it's nice to have independent monetary policy, but it's worth remembering that we've really only had independent monetary policy for 20, 30 years now, and it's the issue has been that it's got to the stage where governments have, when governments used to have to run both, it was their job to get the economy moving, whereas now they sort of offloaded half of that to all the central banks and said, oh, it's not really our fault now, it's all independent. And so that sort of has taken away their responsibility to help keep this stuff all moving in the right direction.
Awesome. Thanks for that, guys. We've got a few more questions here. One of them, actually a couple of questions. What do you think's caused the bounce back in the iron ore price recently?
I really don't know. I would put it down to, fog is what I put it down to. And obviously, the Ukraine war played a key role. Insofar as it knocked out about 40 million tons of iron ore, and roughly the same in steel. But we don't know exactly how much of that is actually knocked out, and there was a fair amount of trade between Ukraine and Russia as well. So there's clearly some disruption in the ferrous markets, and that's played a role. But there's been some real odd behaviour in the iron ore market as well. Like the last week, super heavy buying in futures, and yet spot price has done nothing. And I've never seen that before. If you read it at face value, it shows a very, very well supplied spot market with some speculation in futures. The headwind coming out of China is very big for iron ore, especially the property bust. The infrastructure stuff has sort of started to come through a bit, but some of the MySteel indices and stuff are down 20% in terms of steel demand year on year. I mean, this just overwhelms anything else that there is. Then you've got the impact of the coal price in China, as well as and what that's doing to power prices and steel recycling, which simply hasn't come back as it should have after COVID, and so that's protecting iron ore to some extent. And so all these things are very, very difficult to read, and it's a very, very murky market right now. And of course, then there's the overlay of the complete global commodity panic, which is just buy any kind of dirt that there is, or has been the case. It's easing now, and the part
and the investment push from Wall Street.
Yes, of course. Wall Street cheering on every commodity on earth. So,
yeah. And what I say, I'll flesh that out just a tiny bit more. Is that Wall Street's basically saying to save you from inflation, which is largely driven by commodities. You need commodities in your portfolio. So there's a little bit of a circular argument in there, but it works while that keeps rising. The problem is if that's the only thing pushing it, then when it does go into reverse, all the stuff that pushed it up is the same type of stuff that pushes it down.
Yes. So my answer is I don't know at this point. It's an extremely difficult market to read right now. you know, I find it very difficult to believe that, like, then there's COVID in China, right? Okay, so there's lots of transport disruption right now in China, and Tangshan is basically going to shut down or has shut down, which is like 13% of Chinese steel output, and that's sent the prices up. You know, like, I can understand why it would raise the steel price, but why it would raise iron ore is anyone's guess. Because it's less iron ore. But then there are supply constraints right now on Omicron in China, like in things like getting the iron ore from the ports to the mills. But again, that shouldn't raise the price, but it has. So there's just a lot of cross currents in the market right now that it's very difficult to read. I would say fundamentally, as things kind of settle down, the fundamental driver is still Chinese property. It's going to get some help from infrastructure, but that headwind is still huge to demand. And there's plenty of supply, so it still looks very overvalued on a fundamental basis. But when it falls, it's difficult to say because it's just so opaque right now. So yeah, there you go.
And I think feeding a little bit into that whole question is sort of similar with oil. I guess oil is probably a little bit easier when you look at sanctions and things like that on Russia. Is you can sort of see where oil hasn't been explicit, or it's actually been specifically carved out of a lot of the sanctions, and it'll probably end up eventually in places that are happy to take it, places like India or China. And then as you go through various products, wheat, India and Ukraine and Russia are both big exporters of wheat, and so can those same countries sort of also take a lot of that? And you sort of go, yeah, okay, that's you can see a potential for that, at some point. Gas is a lot harder. In terms of gases, it's just it's difficult. Russia doesn't have the facilities to get the gas to India or get the gas to China in sufficient volumes to take a to sort of rebalance that market. And then you start looking at, say, iron ore, and as Dave says, it's the part where both Russia and the Ukraine produce some iron ore, and they both produce some steel. But the question is, where's that steel going to end up? And if there's just 40 million disappears of steel and 40 million disappears of iron ore, then that iron ore needs to get made up elsewhere, and maybe the steel needs to be produced now in China and sent to the Europe, or produced in other places in Europe. So there's a lot of those, I guess, frictions that we're looking at in terms of trying to work out where these are.
Yep.
Back to you, Sam.
Awesome. Thanks for that, guys. So now we have our viewer question of the week. This is for viewers to have some discussion in the comment section over the coming days. The question for this week is, should you buy the dip or sell the rally? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And we've just got one final viewer question that's come through here. So with all these different sort of risk factors, what do you think the probability is that we actually will experience a recession?
Well, I think it's my base case that we're going to see something akin to a global recession. Would we have an Australian recession as a result? Probably not. But that will depend on any number of factors, especially the timing of this. If it does come in more quickly than usual, which is also my base case because everything in this cycle has been so accelerated, and I'm seeing so much kind of early warning stress already anyway. Like, for instance, normally an inverted yield curve might indicate a recession 1 to 3 years out. I think it's more like 6 months this time. So I do think there's a fairly deflationary bust coming in the global economy. The question is, would the RBA get rate hikes off before that happens? Look, probably it looks like it will now. But I think it will be touch and go, but that'll play a role in whether Australia joins the world. And And then we'll have the same asset price busts as the world does, which will also impact things. Our housing markets are already falling. Equities would fall here as well, of course. And so you'd have the same sort of blow to consumer confidence. Whether that would be enough to actually cause an Australian recession, assuming we had a commodities bust as well, then that plays a role. I would say probably not, because there's a fair bit of momentum in the local economy and stuff. But in terms of asset prices and things, that's going to be pretty immaterial, I think. So base case global recession, which is anything around 2% growth. Australia takes a pretty serious knock, especially on asset prices. Probably doesn't get in a recession unless it's out a little further. So that happens in 2023, and the RBA manages to hike rates like 4 times, and then suddenly housing's falling fast in 2023. So, which it would be, I suggest.
Excellent. Okay, Damo, have you got any thoughts on that?
Yeah, there's a couple of I guess questions about some of the fund questions. I guess one in particular from Jude, talking about the growth fund sort of having a tough run for the last couple of weeks, and the idea about the Aussie dollar ETF and Aussie bonds in play. And look, I think for both those assets, within every portfolio, there's your ones there for offense and your defense, and trying to balance that scenario in terms of it. And so while the equities are sort of providing one side, those have obviously haven't helped on the way up, but we do think they're sort of pregnant with a bit of performance, and there's potential for us certainly on the bond side to possibly even take a little bit more exposure given how far they've risen, and particularly in the Aussie bond side in terms of relative to the global market. David spoke about how the US market's signaling a recession. The Aussie market bond yield curves are signaling the opposite. And so, they're basically as steep as they've been in a long time. And so from that perspective, we do think there's some mispricing. A lot of it comes down to your assumption about the things we've been talking about today. Are these headwinds in Europe, the headwinds in China, and the headwinds in the US enough to slow growth? And in our mind, that's growth in commodities in particular. And in our mind, that's a bit of a given. Is yes, we do think those all those factors will come to play and will actually slow the growth in the commodities market, and that's where you'll see the effect come back on Australia. Now, if that doesn't happen, then then those plays obviously won't work as well. The flip side is we'll perform a little bit better on the equity side, and but yeah, we'll certainly in that if we're picking scenarios where we think we'll outperform, is it scenarios where the factors we spoke about today come home to roost, and markets start to incorporate that into the valuations. And we saw, so as Dave spoke about, we saw that as the effects of the war were started to be factored in. We think there'll be another sort of shoot or drop as growth starts to slow, and we're certainly seeing a lot of leading indicators. The question is when it happens. Could it take 6 months or a year? In a normal market, absolutely. I'd say we're probably talking 6 months to 18 months to start see it start coming through. Given how fast everything's been moving throughout the last 2 years, and how we've had this cycle on crack, as we like to say, is that could it take 6 weeks rather than 6 months? And the answer is yes, absolutely. If the right sort of phase of watching China slow, some slowing in the US, which is you sort of see the tinge of, and maybe we see as well, there is potential, and I don't want to wouldn't be betting the house on it right now, but there's potential that some of these some of the things we're seeing in China in terms of shutdowns and lockdowns actually frees up the transport a bit more, and actually lets because basically China's not shoving as much in one end of the transport pipe, and that sort of helps to free up some of the blockages, and potentially gets that moving again. So so I guess there's a number of the risks that we think are look imminent, and so it's worth having these hedges in place to in case that sort of all comes through.
Excellent. Oh, thanks for that, guys. That almost wraps us up. But today I just want to take a moment to showcase our new direct indexing products. They're the first of their kind in Australia, but they are available in other parts of the world. So they're similar to an ETF, as in it's a buy and hold passive strategy that tracks an index. But the main advantage is it allows you to customize your holdings in that index. And what I mean by that is you can make any changes to the index as you see fit, whereas a traditional ETF is a one-size-fits-all that you can't change. And with direct indexing, you own all the stocks directly, and you can customize the index by utilizing any of our ethical and sector screens. So you can exclude Australian banks, for example, or exclude coal stocks, or add technology stocks. You really have the ability to customize your portfolio to align with your ethical values and beliefs. And we have around 50 different screens to choose from. So please go to our website at nucleuswealth.com/direct indexing and have a look at that there. So that wraps us up. So Damien, just want to thank you for sharing your knowledge as always.
Thanks a lot, Sam.
And Dave, great insights, and thanks for coming on the show again.
Yeah, pleasure. Thanks, Sam.
So we do welcome your feedback on the show, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the YouTube comments below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and book a call with me or one of the team. And finally, don't forget to like the video now. And if you know anyone that might get some value out of today's episode, we'd really appreciate it if you please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.